As we come to the end of yet another turbulent year, the global economy is still marred by profound shocks and unprecedented uncertainty. Mixed signals are emanating from geopolitical situation and financial market volatility. In the beginning of this year, that is 2022, just as COVID pandemic was receding, the war in Ukraine overwhelmed the world in a black swan moment and fundamentally altered the global economic outlook. Surges in food and energy prices and shortages in key staples have severely affected the poorer sections across the world. Though international food, energy and other commodity prices have moderately in recent times, inflation remains high and broad-based, and this is something which we see world over. The IMF has projected that more than 1/3 of the global economy will contract this year or next year. While no country is spared the ill effects of such large shocks, emerging market economies, that is EMEs in particular, the ones dependent on food, energy and commodity imports, have been the worst affected. Looking beyond the pandemic and the war, fragmentation in finance and technology is also adding to the forces of deglobalization. Supply chains are being redrawn on considerations of geopolitical security, leading to what is now come to be known as reshoring and friendshoring. Food and energy security, together with the biggest challenges to the world. In this hostile international environment, the Indian economy remains resilient, drawing strength from its macroeconomic fundamentals. Our financial system remains robust and stable, and corporates are healthier than before the crisis. Bank credit is growing in double digits for 8 months now. India is widely seen as a bright spot in an otherwise gloomy world. Yet our inflation remains elevated, as in most parts of the world. Global spillovers continue to impart volatility and uncertainty. Let me now focus on the deliberations and the decision of the Monetary Policy Committee meeting, and this is something which I think the key thing about which the market is eagerly awaiting. Now, the Monetary Policy Committee meeting met on 5th, 6th and 7th December. Based on an assessment of the macroeconomic situation and its outlook, the MPC decided by a majority of 5 members out of 6 to increase the policy repo rate by 35 basis points to 6.25% with immediate effect. Now, I think this is one occasion where the market expectations and the decisions of the Monetary Policy Committee are by and large aligned, and there are several interpretations whether when the market expectation and the monetary policy decisions are aligned, whether they are, they have to be taken as a perfect monetary policy or otherwise, but that debate can happen some other time. Now, consequent to this increase in the policy repo rate by 35 basis points, the standing deposit facility, that is the SDF rate, stands adjusted to 6%, and the marginal standing facility rate and the bank rate to 6.5%. The MPC also decided by a majority of 4 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. Let me now elaborate on the MPC's rationale behind these decisions relating to the policy rate and the stance of the monetary policy. Growth prospects across the world are dampening. Financial markets remain nervous and are characterized by high volatility and price swings. For the Indian economy, the outlook is supported by good progress of rabi sowing, sustained urban demand, improving rural demand, a pickup in manufacturing, rebound in services and robust credit expansion. Consumer price inflation moderated to 6.8% year on year in October as expected, but still it remains above the upper tolerance band of the target. core inflation is exhibiting stickiness. While headline inflation may ease through the rest of the year and in first quarter of 2023-24, it is expected to rule above the target. The medium-term inflation outlook is exposed to heightened uncertainties from geopolitical tensions, financial market volatility, and the rising incidence of weather-related disruptions. On balance, the MPC was of the view that further calibrated monetary policy action is warranted to keep inflation expectations anchored, break core inflation persistence, and contain second round effects. I would read this sentence again. The MPC was of the view that further calibrated monetary policy is warranted to keep, number one, inflation expectations anchored, number two, break core inflation persistence, and number three, contain second round effects. These actions will strengthen the medium-term growth prospects of the Indian economy. Accordingly, the MPC decided to increase the policy repo rate, as I have said, by 35 basis points to 6.25% and to remain focused on withdrawal of accommodation while supporting growth. As regards the stance of the monetary policy, the MPC took a holistic view of the policy rate and the liquidity conditions relative to inflation. Adjusted for inflation, the policy rate still remains accommodative. Over the next 12 months, inflation is expected to remain higher than 4% target. System liquidity remains in surplus with an average daily absorption under the liquidity adjustment facility, that is LAF, of 1.6 lakh crore in November this year. The overall monetary and liquidity conditions remain accommodative, and hence the MPC decided to remain focused on withdrawal of accommodation. I would now like to provide our assessment of growth and inflation. First, I will take up growth. According to the latest data released by the National Statistical Office, that is NSO, the real gross domestic product posted a growth of 6.3% year on year in the second quarter of this year, driven primarily by private consumption and investment. This also is in line with our expectations. Going into the third quarter of this year, economic activity continued to gain strength in the month of October. Urban consumption firmed up further, driven by sustained recovery in discretionary spending, especially on services such as travel, tourism, and hospitality. Passenger vehicle sales and domestic air passenger traffic posted robust year-on-year growth. Rural demand is recovering, as reflected in the pace of tractor and retail two-wheeler sales, with rising farm activity. Investment activity is also gaining traction. Non-food bank credit, and this is something very important, non-food bank credit rose by rupees 10.6 lakh crore during April to November, as compared with an increase of 1.9 lakh crore last year. The total flow of resources to the commercial sector, expanded by rupees 14.7 lakh crore during this year up to November, as compared with rupees 6.8 lakh crore in the same period last year. On the other hand, the drag from net external demand further accentuated in October, as merchandise exports contracted by 12.1% year on year, after expanding during the previous 19 months. Merchandise exports expanded by 10% in October. On the supply side, the agricultural sector remains resilient. Rabi sowing got off to a strong start. The area sown so far is 6.8% higher than the normal sown area, and this is the position as on 2nd December this year. The manufacturing PMI rose from 55.3 in October to 55.7 in November. The PMI for the services sector also expanded from 55.1 in October to 56.4 in November. Incidentally, both manufacturing and services PMIs for India in November are among the highest in the world. Construction activity is picking up after the end of the southwest monsoon, as indicated by high growth of steel consumption in the month of October. Going ahead, investment activity will get support from government capex. A pickup in share of fixed assets in total assets of manufacturing companies was visible in the first half of this year. I have given the data in the footnote of my statement, and the statement, as you know, will be uploaded in our website immediately after my statement is over. You could have a look at the numbers. According to our surveys, consumer confidence has further improved. I go on. Manufacturing and infrastructure sector firms are optimistic about the business outlook. Services sector firms also expect activity to expand. In an interconnected world, we cannot remain entirely decoupled from the adverse spillovers from global slowdown and its negative impact on our net exports and overall economic activity. The biggest risks to the outlook continue to be the headwinds emanating from protracted geopolitical tensions, global slowdown, and tightening global financial conditions. Taking these factors into consideration, real GDP growth for the current year, that is 2022-23, is projected at 6.8%, with the Q3 at 4.4% and Q4 at 4.2%. The risks are evenly balanced. Real GDP growth is projected at 7.1% in the first quarter of next financial year, that is 23-24, and 5.9% in the second quarter of the next financial year. Now, let me highlight and stress that even after this, marginal revision in our growth projection for 22-23, as you know, earlier we had projected 7%, now we are marginally moderating it to 6.8% for the current year. Now, even after this reduction or revision, even after this revision in our growth projection for 2022-23, that is the current year, India will still be among the fastest growing major economies in the world, and that is something which I think needs to be kept in mind. Let me now turn to inflation. The inflation trajectory has largely evolved in line with the outlook given by us in the month of June, that is in the June 2022 policy. Going forward, food inflation is likely to moderate with the usual winter softening and the likelihood of a bountiful Rabi harvest, but pressure points remain in the form of prices of cereals, milk, and spices. In the prices of cereals, milk, and in the prices of cereals, milk, and spices in the near term. The main risk is that core inflation, that is CPI excluding food and fuel, remains sticky and elevated. Overall, CPI price momentum remains high. Risks from adverse weather events add uncertainty to the outlook. Global commodity prices, including crude oil, have undergone some downward correction, but uncertainty continues to surround the near-term outlook in view of the prolonging of geopolitical hostilities. The outlook for the US dollar and hence imported inflation also remains uncertain. Moreover, the resurgence in domestic services sector activity could also lead to price pressures, especially as firms pass on the input costs. Taking into account these factors and assuming an average crude oil price, that is Indian basket, of $100 per barrel, headline inflation is projected at 6.7% for the current year, with the third quarter at 6.6% and the fourth quarter at 5.9%. The risks are evenly balanced. CPI inflation for the first quarter of next financial year, that is 23-24, is projected at 5%, and the second quarter of next financial year at 5.4%, on the assumption of a normal monsoon.